Yahoo Finance Executive Editor Brian Sozzi here to take a look at a live shot of the opening bells on Wall Street on this Thursday morning, almost Friday. MIAX ringing the bell at the New York Stock Exchange to celebrate its IPO. The company, more formally known as Miami International Holding. Get it? MIAX? Yeah, gotcha. Dominari Holdings, I think I said that right, getting things underway over at the NASDAQ. Now, the September rate cut thesis is taking a hit today out of the block. Investors have scrambled this month to factor in a rate cut at the Federal Reserve September meeting. A tame consumer price index reading early in the week only fed the rate cut narrative, but today's PPI reading has poked a hole into that view. The headline PPI index rose 0.9% in July, well above the 0.2% consensus estimate. Prices were unchanged in June, so you saw that acceleration month over month. Now, investors would be wise not to think tariff-driven inflation is no longer a risk to markets. Clearly, Goldman Sachs and JP Morgan economists have begun to sound the alarm bells on a potential wave of inflation coming soon, which could push out the prospect of those much-desired rate cuts. Now, Opening Bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all of that money in your portfolio. Let's head over to the NASDAQ in Times Square and check in with Yahoo Finance senior reporter Ali Canal. Ali, Bitcoin capturing attention this morning. Besides PPI, Bitcoin prices hit a record very early this morning.
Very early this morning, we are seeing Bitcoin prices take a step back as investors turn a bit risk off following that hotter than expected PPI print. We're taking a look at the major indexes, and we are red across the screen here. The Dow is off around 200 points. The NASDAQ and the S&P 500 are both off around 0.3%. Now, PPI is the prices that producers pay. So we're seeing that businesses are bearing the brunt of these higher costs due to tariffs. That's something that we've been hearing all earnings season, Brian. But Wall Street strategists are now saying it's only a matter of time before that gets passed on to the consumer, and that is really the concern here. I mentioned Bitcoin, so let's take a look at where that's trading today. So if we take a look at our crypto heat map, you'll see that Bitcoin is down around 2%. Ethereum, this has been on an absolute tear, almost touching its own record high. We are seeing Ethereum down nearly 4% at this point, but let's focus in on Bitcoin because over the past month, we've been really struggling to surpass this $120,000 a coin level. This is a technical level that strategists have told us that we should be watching for. If we can get past that and really sustain that level, potentially we're due for another breakout there in Bitcoin. And then Ethereum, I mentioned how that's been on a tear. You look at a month-over-month basis, we are up around 50%. Now that's leading to a lot of optimism on Wall Street when it comes to the future of crypto, and we have seen recent IPOs that really emphasize that thesis. Bullish, for example, I believe that stock is up around 7% this morning after an 80% plus increase yesterday on the heels of that IPO. Now, this is a company that operates a crypto exchange and owns the trade publication CoinDesk. So just, again, a lot of optimism around crypto. But right now, after that hot PPI print, we are just a bit risk off in markets, Brian.
Ali, liking that technical analysis, very Jared Blickery-esque. All right, we'll talk to you back in a
I'm
in trying.
A second. I'm trying to channel Jared.
You're crushing it, Al. You just keep on crushing it. We'll talk to you in a minute. I'm kicking things off with your daily guide to the biggest market drivers of the trading day. Here's my checklist. Number one, a more complete read on inflation, sort of. The producer price index out today painted a picture of an economy beginning to feel the effects of Trump tariffs on the inflation front. The report was starkly opposite when markets learned from the more tame CPI index earlier in the week. So which report is to be followed? We'll dive into this budding thesis. Number two, ripping to records. Despite the heavily debated inflation topic, markets continue to hover around fresh records as investors have rallied around the view of steady rate cuts from the Fed into 2026. Besides just the rate cut narrative, the reality is that earnings season has gone quite well for embattled corporate America. They have weathered the tariff storm and are not hinting at doom and gloom on the economy. So maybe these records are justified. We'll dive into that one. And number three, crypto crushing it. Speaking of records, Bitcoin prices touched a new record earlier this morning. The cryptocurrency has gained 31% year to date and is up 60% from April's market lows. Other cryptos are rocking too. Ethereum is up a sizzling 10% over the past 5 days, and at a record, Solana has clocked in with a 13% gain the last 5 days. On the opening bid roundtable, Truist Co-Chief Investment Officer and Chief Market Strategist Keith Lerner, friend of the show, also friends of the show, Yahoo Finance senior reporters Ali Canal and Inez Ferre. Good to see you all. Keith, coming out of the block with you. Read off of this PPI index this morning is that it's the first sign that producers are going to pass on meaningful inflation on consumers in the months ahead. So does this completely, I guess, end this narrative that we're getting a bunch of rate cuts into next year? Because this is what the market has been trading up on.
Yeah, well, first, say always great to be with you and the crew. I don't think it really upends the overall rate cut story, but we've been in the 2 rate cut camp already. I think, as we heard from Treasury Secretary Besson and others talking about 100 or 150 basis points, I think that makes that case a bit more challenging, at least on a short term. But if you look at this morning, the market is still pricing in more than a 90% chance of a rate cut in September and high odds of 2 cuts later this year. And I will also say we'll have another inflation report before the Fed meeting. And the most important date is probably going to be September the 5th, which is the next labor market as well. So again, I want to overreact to any one report. And maybe the final part of this, really, we've just started to see that tariff revenue come in the last 2 months. So it makes sense that you're going to start seeing it in the actual data.
All right, for a second, Keith, I'm going to forget that we got the PPI index. Forget that I even got it today. Let's just pretend it's yesterday and the market's trading higher because we got a tame CPI early in the week. You did some interesting research looking back on how stocks have tended to react when they hit records. What did you find?
Yeah, well, often, especially for investors that have been here for the last 15 or 20 years, like when we make new highs, people get very nervous. But the data actually suggests new highs are actually very normal. And then when we test out the forward performance after you make new highs, it's actually a year out, you're up on average around 9.5%, which is basically saying that's around average returns in general. So our main takeaway is, as long as the new highs are supported by fundamentals, you should not be nervous. Doesn't mean we can't see some hiccups along the way. We should expect those, but the underlying trend still deserves the benefit of the doubt. And what you mentioned earlier in the show, one thing that's really notable about this recent move up, the forward earning trends for the overall market are also at a 52-week high or an all-time high, and that's been supportive of these markets. And
as it's hard to disagree with our friend Keith when he's packing that type of research, but look, this inflation data that we got out today is a concern. And it really plays to that narrative we've heard more recently from a Goldman and a JP Morgan more recently that we're on the cusp of major inflation, and perhaps third quarter earnings season for corporate America may not be so hot.
Yeah, look, it's a difficult task right now what the Fed is faced with, this inflation data and also with the weakening labor market. It seems to be like 50 basis points would be off the table. I do also wonder if the Fed would say in Jackson Hole anything about tariffs and looking at it in a way of, well, maybe this is a one-time kind of tax, so to speak, or a one-time bump up. But then after that, things should ease. And I wonder if eventually the Fed would say something to the effect of, well, look, inflation is trending lower, perhaps a little bit above 2% is okay. That's what the market would be banking on. But I also wonder if investors are going to buy the dip, which is what we've been seeing over and over again. So we're not seeing the markets off that much. So the concern isn't too high that the Fed won't step in and cut rates this year.
Allie, I'm not feeling this PPI report. I'm just not, mostly because it's beyond the headline. When you go line by line, you're seeing really increases, or you saw increases across the board, and in many cases, strong accelerations month over month.
Yeah, and I think this just reaffirms that the Fed is stuck between a rock and a hard place when it comes to the tension between its dual mandates. Obviously, we got that CPI report the other day that markets really cheered. It was better than feared in a lot of ways, but let's not forget that core CPI is still sticky. Along with that, services inflation firmed up a bit, and that has been easing heading into the summer months, and that really has been offsetting a lot of the increases we've seen in core goods. So that's been a concern that economists have told me, that if we continue to see services trend up, that's something the Fed is going to really be paying attention to. But as Keith was saying, we still have a decent amount of data that's set to come. Earnings season was really, really strong. And earlier this week, we saw Citi increase its price target for the S&P 500. And they specifically cited that in the out quarters for earnings, along with 2026 and beyond, that just continues to trend higher. So as long as companies can continue to beat, that's a positive. The concern, though, is that as companies continue to absorb these tariff costs, it's going to hit margins at some point, and then they're going to be forced to pass that on to the consumer. And then if the consumer is squeezed, and if they start to lose jobs, if the labor market weakens, then that's going to hit on growth. And then you have that scary stagflation scenario that we were talking about earlier in the year. So far, that doesn't seem to be a big risk. Like Inez was saying, markets are not off too much. We're seeing yields edge up slightly, but still the 10-year yield firmly below 4.3%, and markets are still pricing in that September cut. So I'm very curious to hear what Jerome Powell says in Jackson Hole and how he telegraphs the Fed's next move.
Keith, Ali brings up some good points on corporate earnings. Are investors getting ready for a third quarter earnings shock? And not to sound like a doofus or anything, I'm not trying to hype this up or anything, but if we're going to get this inflation to the extent that a report like the PPI suggests, second quarter just might be the margin peak for corporate America.
Yeah, it's a fair point, and it's certainly a risk. We also know from some reports, even from UPS, that a lot of these companies brought in inventory before the tariffs went into effect, so therefore their margins were probably helped. UPS also said that a lot of those inventories have been depleted, so it's a risk. But I would also say, so this is definitely a risk, and we'll likely see some hiccups along the way. But let's look beyond just the PPI inflation. The one big beautiful bill. A lot of the analysis that we've looked at on this suggests there's actually some offsets, and you think about cash rates are coming down. There's some incentive for CapEx as well. So again, I just wouldn't look at any just one factor. I definitely think this is maybe one of the key risks as we move later this year. But at the end of the day, we've seen our companies adjust. After COVID, after inflation shocks, after the fastest interest rate cycle in history, they also gain some more clarity as we move forward, even on the tariff front. So again, I think the benefit of the doubt is still that the trend is intact, but you'll probably have some bumps along the way.
Keith, I don't want to put words in your mouth here. I don't think you're a big crypto guy. I'm sure you've been watching these records that have been happening in Ethereum and Bitcoin. What are you hearing from clients, and what do you think about these moves? And keep in mind, they're coming alongside the general rise in the broader stock market.
Yeah, well, the one thing I'm hearing, it's just becoming more commonplace. Now, a couple of years ago, it was on the fringe, and it's just, you're seeing more of just like adoption. Even average investors inquire about it more. As from how it's trading, a couple of things that stand out in our work. One, the correlations to the overall market, which used to be 0, are now moving up to the NASDAQ to be about 0.5. So it's a bit of a leverage play on the overall market. That's why even on today's PPI, you see the market down a little bit. It's moving more as well. So the diversification aspects of it is changing, but you're also seeing greater adoption, as you covered earlier as well. A lot of this also trades on technical and sentiment, and that's what we're seeing a lot of investors follow as well.
And as I read a story from you this morning at 3:32 a.m. on Bitcoin, and it was Bitcoin touching a record. So kudos to you on staying on the pulse on Bitcoin. Just curious on what you're seeing and hearing as you report on this.
Yeah, look, like what Keith was mentioning, it's really about institutional adoption this time around. Whereas in the past, we have talked a lot about the retail investors. Now it's really institutions. It's corporate treasuries that are buying. It's companies that are trying to play the same playbook as Strategy, which holds the most Bitcoin out of the public companies. So you have this trend that is happening, and not just with Bitcoin, but also with Ether as well, as you were mentioning, near record highs. You have projects that are being built on Ethereum. You have stable coins being built on the Ethereum architecture. And then you've got the regulatory tailwinds from the government. I mean, you have the Genius Act that was passed. You have the 401k initiative that Trump is going for. You have Scott Bessent this morning that was saying in an interview that the U.S. is going to keep its Bitcoin holdings, that they are worth about 10 billion or 15 billion, and it won't be selling anymore. So when you have the government that is really pushing this, it's hard to bet against that. You had Eric Trump, who himself is also involved with crypto initiatives, who tweeted out last week, don't bet against BTC or ETH, or you will get run over. So when that is happening, you see the entire market sort of jumping in.
And who the hell wants to get run over? Inez, thanks so much for your round-the-clock coverage on crypto. And thank you to my roundtable, Inez Ferre, Ali Cannell, and Keith Lerner. All right, straight ahead, Amazon has just terrified your local grocery store manager, and Cisco's new CFO enters the opening bid hot seat, fresh off better than expected earnings last night. We'll be right back. Welcome back to Opening Bid. When Amazon goes big on something, usually the stock prices of its competitors get totally beaten up. The latest example came on Wednesday. Amazon announced plans to expand its 1,000 city fresh same-day grocery delivery to 2,300 cities by year-end. Huge deal for the grocery industry. Albertsons and Kroger, aka traditional grocers, show their share prices nailed. Instacart was hammered too. I'm not seeing much appetite, no pun intended, to buy the dip in these names this morning. I think that's a big deal for the industry and for Amazon. The impact of Amazon's move won't be felt overnight, but just like the company's impact on department stores in recent years, the aftershocks will be felt over time, said the team at Wedbush on this one this morning. Quote, "This is an important step forward in Amazon's broader strategy and should help the company capture incremental share in perishable categories where they have struggled historically." All right, Cisco is out better than expected earnings and an outlook that came in higher than some estimates. The company touted its AI order book on its earnings call last night and momentum in its bread and butter networking business. Stock is under pressure, though, as some of the street are concerned about sustaining the strength in the network business and more sluggish growth in the security business. Cisco's new CFO Mark Patterson joins me now for our Power Player segment. Mark, good to see you here this morning. Let's try to pick apart a little bit of this stock sell-off. On the networking business, sales up double digits, good quarter for you guys. That's the bread and butter Cisco business. How confident are you that you will still be putting up double-digit gains if we had this conversation 3 quarters from now?
Yeah, thanks, Brian. So first off, just thanks for having me. Excited to be here. I think it was a really solid quarter. So I want to thank the teams for the execution during the quarter, particularly with my first quarter as CFO. It was a beat on both the top and bottom line. Revenue came in at the high end of our guide. So did gross margins and operating margin. And then EPS came in above the high end of our guide. So really pleased with the performance during the quarter. We saw, very balanced growth across all of our geographies. We also saw growth in each one of our technologies as well. So, very, very balanced quarter. As you mentioned, a lot of strength in networking. Revenue grew 12%, and that's frankly where I think a lot of the where a lot of the tailwinds are today that we're seeing, and we can certainly talk more about that. Security also, showing I think real solid improvement there, and a lot to be excited about in terms of where we're taking that portfolio over time.
All right, what's the biggest driver? I'll follow up on the networking business, Mark. What's the biggest driver of that networking business, and how do you see it moving from here?
Yeah, so if you think about it, I would say AI is really the biggest driver in terms of the overall umbrella. When you look at the web scale space, certainly the training build-outs that they're doing in the back end has been a big tailwind for us, and we can certainly talk more about that. We took over $800 million in orders in the quarter, exceeded our original target that we had put out for the web scalers and that AI backend build out of $2 billion. We put out a target of $1 billion and actually came in over $2 billion, so more than double our original target. Then as you look at the neo cloud build outs, the sovereign build outs, those are still really yet to come for us. The enterprise space is still very nascent, but we think will ultimately be a larger opportunity than what we're seeing in the training build outs with hyperscale. And then frankly, what you're seeing a lot of right now is enterprises really preparing for AI and the applications that they will ultimately deploy. So while some have already started, you're seeing them upgrade their network, upgrade their security posture, et cetera. And so that's going to be a really good thing for Cisco as well.
Mark, people that I have talked to that cover Cisco have told me that Splunk, that $28 billion acquisition that closed more than a year ago, demand has started to slow down there after Cisco's acquisition. Can you comment on that?
We really haven't seen that. Splunk continues to perform at or above our expectations, both on the top and bottom line. So really encouraged by the performance there. We've done a lot to integrate the teams. We've done a lot of integration in terms of the product development, but also bringing the sales teams together now. One of the things that we saw as a real nice pickup in terms of why we wanted to do the acquisition was bringing this go-to-market together in the last 2 quarters. Each of the last 2 quarters, we actually have over 300 new logos in both Q3 and Q4. So the teams are working together, the incentives are really aligned, and I think that we've got a better, more complete offering for our customers.
I'm asking all CFOs this one, Mark. I'll put this one to you. What have you done in the past 90 days to mitigate the tariffs that the Trump administration has passed through? I mean, Cisco's a global company, of course.
Yeah, we've done a lot, as you'd expect, actually. So we've got a world-class, global supply chain, and I think this is one of the places where our scale actually is an advantage for us. So the teams have been working hard. We laid out the very specific assumptions, if you will, that underpinned our guide as we move forward in terms of tariffs. It was really just a slight headwind in Q4 and also for FY25, and we'll continue to work those mitigation efforts as we get more granularity in terms of what to expect going forward.
You baked in the tariff impact into your new fiscal year guidance. From an EPS standpoint, how much do tariffs hurt Cisco's earnings?
We haven't said the specific amount, but again, I'd say it was really just a slight headwind in terms of the total that obviously hits our COGS. But overall, very pleased with what the teams have been able to do and encouraged by our ability to mitigate those tariffs. If you go back to the initial tariffs that Trump had put in place on China in his first term, we actually have mitigated over 80% of those tariffs.
And Mark, while you may be the new CFO of Cisco, you've been at the company, I believe, since September 2000. That's not too far removed from the post-dot-com crash. You've seen a lot in the tech space and at Cisco. We're here trading at record high valuations. Tech stocks have gone through the roof. They're trading at record high valuations. Does it feel like that same bubble-ish activity that we saw in late 1999 and early 2000?
Yeah, I think so. As you mentioned, I've been with the company now 25 years in a variety of roles and responsibilities, and it's been a long time since I've seen the kind of opportunities that we have ahead of us. When you think about the AI infrastructure space, as I sort of outlined between, the hyperscale space on down into the enterprise, and all of the sort of preparing that the network or that the enterprises need to do in terms of upgrading their security and network posture, the way networking and security are really coming together as we move into agentic AI. That's really the only way you're going to be able to deal with the escalation in terms of the threats that you're going to see from AI. So I think that this combination of AI infrastructure, security, the way we've upgraded our hand in the Splunk acquisition there, and we're continuing to roll out new innovation there. And then this overall sort of campus refresh that we're talking about as well. There's a lot of older equipment that is with our customers. We rolled out, I would say, probably the biggest innovation payload since I can remember anyway, while being at Cisco, across all of our portfolio, and so pretty excited about the opportunity ahead. We've got a lot to do, certainly, but big opportunities that we have in front of us.
It's also an interesting moment, Mark, for the role of the CFO. We're seeing a lot of CFOs to start to diversify sizable cash holdings into crypto assets. And I see what GameStop has done, MicroStrategy, and they're fine, but Cisco is more, it's a piece of Americana. It's an iconic company. Have you had those discussions internally, and can you envision putting your sizable cash position, even a small part of it, in crypto?
Yeah, I think we're pretty conservative with our cash, certainly in investments, and our commitment to return cash to our shareholders. It'll be something that we continue to look at moving forward, but I don't see that having a big play going forward.
So your priority is still more focused on using your cash to buy back stock, is that correct?
Well, I think the first priority of the cash that we generate is really to fund the operations of the business and the innovation and the markets that I talked about earlier and the kinds of opportunity that are ahead. Secondly, would certainly be the dividend that we've got. Third would really to be offset any dilution relative to stock that we grant to employees, as well as opportunistically looking at any additional money over and above that, or what we want to do to deliver value back to our shareholders.
All right, we're going to leave it there for now. Cisco CFO Mark Patterson, good to see you. Good luck in the new role. We'll talk to you soon.
Thank you, Brian. Appreciate it.
Appreciate it. All right, coming up, Julie Hyman has you for Market Catalyst. Don't go anywhere.